Hey there, fellow investors. Hey look, today I want to have a good chat about US Bank Corp, USB. Now, before we dive into it, let me just say that this report from Holdco Asset Management has got me some pretty strong feelings here. I mean, look at it. They're calling USB the unsafest and the unsoundest of them all. Ouch, that has got to sting. So what's up? What is their beef with USB? Well, according to Holdco, USB has been hiding a capital and liquidity hole simply by changing their classification to a Category 2 banking institution, and they've been doing some other pretty sneaky maneuvers as well. They're not the only ones who are thinking about this. Holdco is actually calling out Wall Street analysts and ratings agencies simply for regurgitating management's narratives, repeating what management wants them to say. The shots have been fired in this war. So look, Holdco is calling for the Fed to take action and force USB to cut dividends, cease buybacks, or raise substantial capital immediately. They're really not playing around on this one. Okay, so let's take a step back for a minute and just look at some of the facts here. The short report is 85 slides long, and I'm just going to give you the highlight here. So the key metric here for the banks is the Adjusted Common Equity Tier 1 or CET1. According to Holdco, the USB falls well below the minimum requirements and their peers, the nearest comparable peers in this area for CET1. Now they go on then to explain that the changes to the regulatory rules and USB's classification as a Category 2 bank is going to impact the capital and liquidity. Now, Holdco has made some assumptions here around the impact of the Fed's CCAR stress test, and they're going to project that USB will fail. Now, I'm not entirely convinced of their argumentation here. I think for the Holdco report, some of their assumptions seem a bit extreme, and they've also sort of layered assumption on top of assumption, and pretty much all of these extreme assumptions all have to sort of happen at the same time for there to be a major problem. So overall, while the report is factually accurate, it is, however, a very static analysis of the numbers and what's been going on. Now, USB's management team has been taking actions already to address some of these issues around the capital trajectory. So I think ultimately the Holdco report authors are overlooking this management manoeuvring. So, well, the stress tests are going to become tougher. There's no doubt about that, folks. I don't think the situation for USB is going to be quite as serious as Holdco is making it out to be. With the recent price declines, though, USB's valuation now, I think, is looking rather undemanding. It's at a very low PE level, giving, I think, some fairly good upside, and we're going to look at that next. And yes, there are still regulatory uncertainties. Yes, there's still the potential shortfalls in capital that we need to consider. But I'm rating USB as a hold as I'm looking at this now, and I'm going to get into some of the numbers next and explain a little bit more why I think that. Let's have a quick consideration of the Q1 earnings report. Yes, I know what you're thinking. Boring is another bank earnings report. But just hold on 1 minute, folks, because I do think there's some exciting news here that we do need to be aware of. I mean, first of all, let's talk about the deposits. Now, despite the fact that we've had a lot of challenges in the banking sector at the moment, in the recent couple of months, and the recent shutdown of the Silicon Valley Bank, US Bank Corp has only seen a very minor decrease in the deposit base. So that's right, folks. The depositors view them as a safe banking destination. Around 50% of their deposits, or 51% of the deposits, are insured, and they have lots of access to liquidity. So investors here, I don't think, have any real substantive reason to be concerned, either with the deposit or the liquidity situation. But there's more good news, I think. US Bank Corp also saw a very strong year-over-year increase in the net interest income due to the Fed's policies. Now, with the Fed's not showing any signs of slowing down their pace of the rate increases, I think we can also expect the continuation of the net interest income upside throughout the rest of the year here in 2023. Okay, now I know what you're probably thinking at this point. Lincoln, what about the risks? And it's true. I mean, I think the biggest commercial risk for the US Bank Corp is going to be a reboot of the financial crisis and a fundamental change in the trajectory of the deposit outflows. But come on, let's get real here. I think it's unlikely given the Fed's emergency liquidity measures and the stabilisation of the deposit flows that we have seen with the US Bank Corp at the moment. So what's the bottom line when I'm looking at these numbers in the Q1 earnings report? Personally, I think the report was fairly solid. And fundamentally, I think the stock price here has taken quite a dive for no real big reason here. I think the shares are now trading at a large discount to the 1 year average price to book ratio, and I think this is a really interesting point where we can begin to capitalise on the fear in the market and buy a fairly solid regional bank here at a good valuation. Let's have a little bit more of a close look at some of these numbers. Okay, first off, let us look at the net asset value per share. Now this was increasing steadily over 2016 through to 2021, and it's taken quite a tumble in the 2022 year. However, 2023 is expected to see a resumption in the increase in the net asset value per share, with 2024 reaching pretty much the same level as the 2021 peak, and then growing thereon in. Now when we switch over to book value per share, again we see a dip in 2022, and then an increase again in the book value per share. And this is all what I would like to see as an investor. Now the dividend per share has been growing very strongly up until 2022. 2023 is projected to see an increase in the dividend per share, but the increases here on in through 2023 to 2026 are projected by analysts to be a little bit smaller. So a more muted increase in dividend per share of sort of mid-single digits or lower mid-single digits. But still, as we can see here, dividend increases projected to about $1.94 this year per share, the $2.04 in 2024, and about $2.16 in 2025. Now the Outperform platform focuses on analysts and analyst accuracy. Now you can see here that the analyst accuracy here gives us a 4 out of 5 for confidence level, so somewhat confident that these analysts can do a good job of estimating where the share prices should be, and the analysts on average have a 50% predicted upside. Most of them, as we can see from the pie chart, are suggesting a buy, with some of them suggesting a hold. We can see here that the most recent analyst revisions have been to maintain their buy or outperform equal weight sort of levels here, with quite substantial upsides from some of these analysts being suggested. Okay, now switching over to the fast graphs forecasting calculators. A couple of really important things here. The Standard & Poor's credit rating is an A+, very nice to see. Dividend yield is currently sitting at 5.8, which is also very nice. Now look, the analyst estimates here over the last 6 months have been revised down for 2023, as well as 2024, and also for quite heavily for 2025. Now despite this, we've seen quite a substantial decrease here in the share price in 2023 so far. Now I'm seeing this as quite a nice potential opportunity here. Now, if the prices can return to a 13 times price to earnings multiple, and the analysts have this estimate for the earnings correct for the end of 2025, we could be looking at a total rate of return of about 100% here, or an annualized rate of return of about 33%. Now, of course, my friends, that does include the dividend here, and as I said, the dividend increases are somewhat smaller than they have been in the past. Okay, so what do you think, my friends? Hit me up in the comments down below. While the dividend growth seems to be easing off, I think given the price declines here, given the dividend yield, I think this is a reasonable opportunity here to take some risk with some potential for the upside here. Now look, I think the current price to earnings ratio is undemanding. It doesn't really take much here, I think, to turn a profit, as long as we're patient and as long as there's no catastrophic banking system failures. So even if we were banking on, for example here, I've got a 9 times, just over 9 times price to earnings ratio as a target by the end of 2025, up from an 8.3 now, so we're not talking about a substantial margin expansion, but given the strong earnings in 2023 and reasonable earnings growth in 2024, this alone plus dividends is going to give us a 57% rate of return over that time period, or about an 18 or 19% annualized rate of return, which I think to me is quite attractive. And so this is an opportunity here for me that I think I'm going to be looking at in coming days and in the next few weeks, probably starting a bit of a nibble here, maybe starting a position and seeing whether or not I can grow this into a more substantial banking position in the portfolio. So what do you think? Is this a good opportunity for you? Does it fit your needs and your risk profile? Let me know in the comments below, and I'll talk to you soon.